Thanks to the organizers for including this paper on the conference. Thanks to all of you for being here. This is joint work with Audrey Malenko at Michigan, Ramana Nanda, who's with me at Imperial, and Matthew Rhodes-Kropf at Sloan. So I want to start with a motivating quote, which I'm hoping will both kind of preview the question we're after, but also kind of impart some of its importance. So it's a quote by Mark Andreessen, who's one of the founders of Andreessen Horowitz. It's a big venture capital firm. They've invested in lots of big tech companies. And the quote says, Google, Facebook, eBay, and Oracle all had massive flaws as early stage ventures, but they also had overpowering strengths. Aggregate scores, that is from all partners, don't correlate strongly with ultimate returns. With that approach, you get the mush in the middle with no big flaws, but no great strengths. So anecdotally, this actually seems to be a common refrain from people who work in VC. It seems that they see downsides to consensus. So our paper is hoping to contribute to a pretty established literature about how should committees make decisions over ex ante uncertain things, but specifically we're thinking about this in the context of innovation. And there's a long literature which provides compelling evidence that consensus or majority voting rules can be very beneficial when trying to undertake ex ante uncertain projects. But we're going to show you some survey evidence that VCs tend to avoid using it. So VCs tend to favor what's called we call a champions voting rule, which means that basically one yes vote is all you need to undertake a project. And furthermore, when we question them on why they choose to do this, they chose the explanation of catching outliers. They felt that that was the best way to try to catch the best investments, as opposed to something having to do with, say, costly effort or expertise or something like that. So this is something of a puzzle based on what received wisdom says and what we see people actually doing. So our paper is setting out to answer a few questions. The first and kind of biggest is, what are the conditions that could rationalize champions voting as being ex ante optimal? So that falls under two categories of things we're going to look at. The first is, what type of voting model would be necessary? So you can think about different paradigms about how people observe information about the thing they're voting on. So you can think about a truth plus noise setting, or maybe a sum of signals setting, or a binary setting. So what type of voting model would be necessary to generate this? And second, what's the informational environment? So by that, I mean, what are people's priors about the underlying thing they're investing in? So we'll come up with answers to each of these, and then we want to find out, are those conditions that we find consistent with the empirical evidence that we have? And then finally, are the costs or benefits from switching between one voting model to another quantitatively big? So to preview the results very briefly, the voting model that we find is necessary to generate the results is what we're going to call a sum of signals. And what we mean by that is no one voter or investor can see all of the value of the project. A project can be broken down into different component parts, each of which could be observed by a different person. So this contrasts with the kind of truth plus noise setting where we all see the fundamental value approximately plus or minus some IID noise. The second thing we find is required is that the thing we're voting on needs to be distributed sub-exponentially. That is to say, it needs to have a fat right tail. So the intuition for this is kind of as follows. Essentially, if you have a distribution that has a fat right tail, then the best way to maximize NPV is to hit home runs, right? That's the driver of aggregate successes. The more home runs you hit, the better you're doing. Finding marginally profitable projects and investing in a lot of those is not going to do as well. The second bit is that if home runs are driven by one characteristic, then it's better to have a champions rule. Essentially, you want to minimize false negatives at the expense of false positives, right? You want to prioritize reducing false negatives, so it's better, in a sense, to swing and miss at a pitch than to not swing at a pitch at all. Empirically, what do we find? We don't have access to ex-ante distributions of ventures, but we can look at ex-post distributions. So we find that early stage investments have extremely fat right tails, while later stage investments tend not to have as fat right tails. And this is consistent with the voting patterns we find. We find that investors tend to use champions voting rules for early stage investments, but less so. They tend to favor more consensus for later stage investments. Second, we can calibrate a truth plus noise paradigm and a sum of signals paradigm. And we find that conditional on using a fat right-tail distribution of a fundamental, the sum of signals voting paradigm is better at rationalizing the results that we have in the surveys. Finally, Champion's rule is better in terms of catching these outliers. It's 2.7 times more likely to catch a unicorn. That is an investment that gives you at least a 10 times return on your initial, a return of 10 times your initial investment. So it's 2.7 times more likely to find them than majority rules, and 3.7 times more likely to find them than unanimity rules. So I'm going to show you the surveys now. What we did was we surveyed, or we sent a survey to the 55 largest VC funds that invest in US ventures. The reason we chose large VC funds was twofold. One is that these 55 accounted for more than half of the total venture capital raised from it was 2016 to 2018. But secondly, we wanted funds that voted across many different rounds, funds that were involved in seed rounds and also in early stage and also in growth stage, so that was more likely to be bigger companies. So we sent it to the 55 largest, 35 responded, and we asked them formally what their formal voting rules were for each of the three stages here. So we had seed, early stage, which were rounds A and B, and then growth stage, which were rounds C, D, and later. And so the dark blue is effectively the purest form of the Champion's rule. Dark blue says that basically one enthusiastic partner can do a deal. Light blue says that one enthusiastic partner can do a deal if there is no veto. So if you lump those together loosely to say they're both kind of a Champion's rule, it seems that 90% of of the firms that invest in seed rounds use some form of a Champion's rule to select their ventures. In early stage, that drops to about a little over half, or maybe exactly half, and at growth stage, it drops to about a quarter. Majority rules tend to show up at the beginning a little bit. Again, dark gray corresponds to a pure majority, light gray corresponds to a majority without a veto. And then that grows in importance across the round. So for early stage, that jumps up to about 30%. By growth stage, it's about 50%. Unanimity rules play no role in seed stage investments. They seem to play a small role in early stage and a slightly bigger role in growth stage. But the takeaway from this, and actually I'll show you the next slide first, after asking them their formal rules, we asked them about their informal rules, and it turns out that informally, vetoes don't seem to matter. So informally, the dark blue is our Champion's rule. One enthusiastic champion is sufficient to do a deal, and that is basically the sum of the light blue and dark blue on this graph. Similarly, the light blue here is the majority of partners, and that seems to be the sum of the gray bars on the previous graph. Now this is nice because it's within a VC. It's one VC voting across 3 rounds. And it seems to show that Champion's rules are very important the earlier the stage is, and then as you get later and later in the maturity of the company, that tends to drop. So this was our first survey. What we did second was we sent the results of this first survey back to the same 55 companies and posited a few explanations and asked them what they agreed with. So the first explanation we came up with was potentially early stage investments require some kind of specialized expertise, more so than late stage investments. And so partner discretion is a good idea because you can have your biotech person be in charge of biotech seed level stuff. So we call that expertise. Then we had one which harkens back to this kind of Mark Andreessen quote, which says that requiring too much consensus is going to make you pass on the best deals. And so you're not going to be able to catch outliers as effectively if you require too much consensus. So we called that catching outliers. And then the third one was early stage ventures are small. So maybe it's not worth the costly due diligence to have every single partner investigate these together, so you just have one person do it. So we call that effort. So, oops. So here we asked them to rate them. So we had strongly disagree, somewhat disagree, neither, somewhat agree, and strongly agree. So here again, it seems that the catching outliers explanation appears to be the biggest one. At least 80% said they somewhat agreed with it, and at least 50% said they strongly agreed with it. The other two didn't capture quite as much support. Another way to see this is the fraction of the time that one of the explanations was ranked the highest. So catching outliers was at least tied for first 80% of the time, and was solely in first place 40% of the time. And the other two explanations were somewhat less important. So to recap, we have that venture capital funds tend to use champions rules for voting on seed stage ventures. They tend to move slightly more towards consensus for early stage and growth stage ventures. And the reasons they put forward for doing this are at least significantly, in part, it has to do with catching outliers. So we're going to try to build a model to capture these facts. So we're going to have our model set up as follows. We have a committee with big N many partners. The committee has an investment opportunity. The investment opportunity is going to cost I and yield a payoff V, where V is random and has an expected value that's less than I, so your ex ante beliefs before you receive any signals about V are that you would not invest in the project. The committee needs to decide whether or not to accept this, and each partner or voter, or however you want to think about the agents, are going to receive a signal, theta I, about this fundamental V. They're going to be able to vote. So each partner can submit a binary vote. 0 means no, 1 means yes. The committee has a voting rule, K, which it can pick. And the voting rule works such that the sum of the number of yes votes has to be bigger than or equal to K. So for a champions rule, this means that K would be equal to 1. So 1 yes vote would be sufficient to do the deal. For K equal to just over a half, that would be majority rule, so you need at least half the partners on board. And if K is equal to N, that would be a unanimity rule. So each voter will vote yes versus no if and only if her private signal exceeds a certain threshold. And so now what we're going to do is I'm going to, yes?
Why aren't they taking into account the other votes?
They do. The theta, it's going to be I'm going to show you it in a sec. They do. So now what we're going to do is we're going to try to look at a couple of different paradigms and see which one makes the most sense. So the first paradigm is going to be a truth plus noise paradigm. So in this setting, the signal that each person gets is going to be V plus or minus some noise. And the noise is going to be IID distributed across voters with some distribution. So the threshold is going to be defined by this. So this takes into account what everybody else is doing. Effectively, this condition says that if theta 1, if the first investor is the pivotal investor, it means that voters 2 through K have already voted yes. Voters K plus 1 through N have already voted no. And theta K star is going to be the value that makes you indifferent, that makes the marginal voter indifferent between investing or not. So they take into account what everyone else is doing, and under the conditions that they are pivotal, that's what's going to determine your theta star K.
What about the information in what everybody else is doing?
Sorry?
In other words, the other person's vote is in the information set.
Yes.
They should then infer what that person's information was.
Yeah. That's what's happening. It's the conditional expectation, right? It's V conditional on everybody's vote, so you update based on that. Okay, so this is our first paradigm, and so the threshold is going to be defined by this equation. The second paradigm is going to be one which is a sum of signals. So sum of signals means that suppose that the fundamental value of the company is driven by many different characteristics. So there's big M many characteristics, and big M can be bigger than the number of possible voters. So voters can't see all of the things that drive the value of this company. This is a Stark setting. You could assume that there's some common component which is knowable or that the signals are correlated. We're sticking with the Stark setting because 1, it's more tractable, and 2, it's sufficient to generate the results we want. So suppose that each of the characteristics is distributed over some open interval with a certain distribution function. Only some of the characteristics are going to be observable. So now the threshold is going to be given by the following rule, which says that the threshold conditional on, is this it? Yeah. Conditional on K minus 1 many yes votes and N minus K many 1 no votes and M minus N many unobserved characteristics has to be equal to I. It's a similar condition to the previous one, but this is actually a lot more tractable to work with. So one nice thing about this setup is that it's very straightforward to show that the threshold for voting is going to be negatively related to K. So basically what that means is that if you're in a unanimity framework, then you're only pivotal when everyone else has already voted yes. So your threshold for voting yes is going to be low. In a champions model, you're pivotal when everyone else has voted no. So your threshold needs to be pretty high. So the threshold is going to be inversely related to the K. And it also gives us what this framework gives us is that one great theta I can give you a very big V. And in such a framework where you have one really great theta I and a bunch of not so good ones, a champions model is going to let you invest in that, and other models are not. So that kind of comes out cleanly from this. So if one great theta is going to drive your V, then a champions model is going to be good at picking it up. So what are the conditions under which you would actually want that to happen? We have a couple of analytic results in the paper that I'm skipping over for time, but the one I wanted to show you was this one, which says that if you assume that the fundamentals are distributed according to a Pareto distribution, which is often used for innovations, then for a sufficiently fat right tail, that is for a sufficiently low alpha in the Pareto distribution, a champions model is going to be the one that maximizes your NPV. And so this is because of two things. One is that NPV is going to be driven by these kind of right tail outcomes. And the second is that the right tail outcomes are driven by very few, very good characteristics. So the ability to pick up on those very good projects relies on picking up on a very select few good characteristics. And the champions model is going to be the best at doing it. So to compare, to show this a little bit more cleanly, to compare this with the truth plus noise paradigm that I had just before, we're going to do a calibration exercise, or a simulation exercise, sorry. We simulate using the following parameters. So suppose that the number of voters is 5. We're going to assume that M is 20, so the number of characteristics is 20, so you're only capturing about a quarter of the relevant characteristics. We'll say that I is 1, that V is drawn from a Pareto distribution, where alpha is equal to 1.7. That comes from one of the distributions we had on ex post returns. And finally, that in the truth plus noise framework, the volatility of your noise is 1. So I want to show you two sets of graphs. The left-hand graph corresponds to a truth plus noise environment. The right-hand graph corresponds to a sum of signals environment. On the x-axis of both graphs is V, so this is the value of the project. And on the y-axis is the probability of accepting that project under 3 different voting rules. So blue is a champions voting rule, red is a majority voting rule, and yellow is a unanimity voting rule. And so in a truth plus noise framework, basically you always accept good projects. And the reason for this is that if you have a very high V, then all of your V plus epsilons are also probably going to be very high, which means that no matter the voting rule, you'll pick them up. So acceptance goes to basically 100% once your V is above a certain level. As you go further down the distribution, it turns out that majority rules and unanimity rules are pretty good at picking up mid-range projects, while champions rules are not that good. So it turns out actually that in a truth plus noise environment, for any parameter setting, we were never able to show that a champions rule would be best. It turns out the majority rules are always best in this kind of frameworks, and that you would never want to use a champions rule. So that seems inconsistent with what we found in the survey data. The flip side of this is that in a sum of signals environment, basically the odds that you pick up a really great investment is if you see the characteristic that drove that really high valuation. So if we say that a V is driven by one really great theta, there are 20 possible thetas and there are 5 voters, so the odds that one of you saw that really great theta is a quarter. So the probability of picking up a great investment is going to be basically a quarter under the champions rule and negligible under either of the other 2 rules, because requiring too much consensus is going to overlook the positive value of that one good outcome, or that one good characteristic. So this is the ex-ante probability of accepting different projects. This is the ex post distribution of returns conditional on accepting them. Yes.
I don't want to hold you up too long.
That's all right.
Go back to the previous slide.
Yes.
Why don't I say the only way that guy can vote in favor of the project is if he got that characteristic?
Beg pardon? That is what it's saying. It's saying that you only accept this project conditional on seeing the characteristic that drives its value.
Other people will sit there too and then change their vote.
But so if they could communicate this, I agree, it would weaken it, right? But I can't condition on seeing other people's signals. I can only see their vote, right? So I know the vote's above a threshold, but I won't know how far above the threshold. That's all. We can come back to it afterwards, hopefully. So this graph is going to be these are ex post returns. So basically here again, the right-hand side is sum of signals, the left-hand side is truth plus noise. The x-axis is again, in this case, ex post returns instead of V. And so the y-axis is showing you the probability distribution of different returns conditional on the 3 voting rules. And again, over here on the right, you can see that basically all three rules are equally good at picking up high-value investments, that majority and unanimity rules are better at picking up mid-level investments, and the champions rule is pretty bad at picking the same up. On the other hand, in the sum of signals environment, although it's small, the number of investments you pick up here, it's entirely driven by the champions voting rules. And once you get to majority and unanimity, this is the kind of mush in the middle that we were talking about in the Mark Andreessen quote. So this seems to validate the sum of signals kind of paradigm as being the better one for matching what we find in this VC voting behavior. Okay. The last bit of stuff I want to show you has to do with the distribution that we're assuming. I've been talking about how the distribution of the fundamentals should be sub-exponential. So is that justified? Like I said, we don't have access to ex-ante distributions, but we can see ex-post return multiples. So what we've done here is we have data from Correlation Ventures. These are investment rounds that were undertaken from 2006 to 2015 and then exited before the end of 2019. And we've lumped all the rounds together. So this is seed stage A, B, C, D, and later. And on the x-axis, we have the percentile of the overall distribution. On the y-axis, we have the return multiple. So two things to take away from this. One is that basically half the time you invest in a startup, you lose all your money. These are gross returns. And then the other thing to notice is that the right tail is quite large. So by the time you get to the 95th percentile, you're at 20x. The 99th percentile, you're at 50x. So a very significant fat right tail. To break this down by round, we do the exact same exercise, and then we normalize it by the overall distribution. So here we've broken it down by round, so seed, round A, round B, and then we lumped everything C and above into one group. So basically, if this line is upward sloping, it means that its distribution has an even fatter right tail than the overall distribution, and if it's downward sloping, it means it's less of a fat right tail than the overall distribution. So to take away from this, the seed round has an incredibly skewed distribution. 75% of the time you lose all your money with a seed investment, but by the time you get to the 99th percentile, it's 125x. Again, remember this is relative to the aggregate. The round A also appears to have a fatter right tail than the overall distribution, while rounds B and C are downward sloping and therefore would have slightly smaller tails. So quantitatively, how does this affect us? If we underdo that calibration and try to figure out what are the odds that I can pick up what we'll call a unicorn, say getting a 10x return on your investment. Again, this was with n equal to 5 and m equal to 20 in the same parameters. We find that there's basically a 20 basis point chance you do it under unanimity, 29 basis points for majority, and 118 basis points for a champions rule. So this is when I say adjusted or unadjusted, it just means accounting for the time value of money or not. And then if you have 25 investments, the probability that at least one of them has a 10 times return is going to be 15% for a unanimity rule, 20% for a majority rule, and 55% or 56% almost for a champions rule. So we also do a few extensions. So we have a setup where we do voting with noisy communication. Basically, this means that after I've received my signal, I'm able to communicate it to the group with some noise, so a noisy communication of the signal I receive. We also have voting with imperfect communication. That means that with some probability, I'm able to accurately convey my signal to the rest of the group, and with some probability not. And we also have voting with heterogeneous preferences, which is to say that I value my signal more than other people's signals. The flip of this, and the last thing I want to mention before I conclude, is that this has a nice kind of counterpoint. Fat right tails means that you need one yes vote to do the deal. The flip is also true. If you have fat left tails, one no vote should undo the deal, right? So effectively, if you have fat left tails, the optimal voting rule switches to become unanimity. So to conclude, where am I? To conclude, we find that VCs use champions voting rules, and specifically they use it to try to catch outliers. VC investments have return distributions that appear to be sub-exponential. We do some formal estimation of this in the paper. This can be explained by a voting model where the paradigm is the sum of signals as opposed to truth plus noise, and the quantitative effects appear to be substantial. So thank you for your time, and I look forward to the discussion.